Welcome to the most comprehensive guide on smart money technique divergence you'll ever encounter. I am delighted to be your guide through this fascinating journey into one of the most powerful concepts in modern trading. Over the next presentation, we'll explore how institutional players, banks, hedge funds, and major financial institutions leave footprints in the markets through correlation breaks that we can identify and profit from. SMT divergence isn't just another technical indicator. It's a window into understanding how the smart money operates. When two normally correlated markets suddenly stop moving in sync, it often signals large institutional players positioning for significant moves. By the end of this presentation, you'll have a complete toolkit for identifying these institutional footprints, understanding what they mean, and applying this knowledge to your own trading strategy. So settle in, prepare to take notes, and let's unlock the secrets of smart money technique together. Right then, let's dive straight into the heart of the matter. What exactly is smart money technique, or SMT divergence? Imagine you're watching two dancers who've been perfectly synchronized throughout their entire performance. Suddenly, one dancer breaks rhythm while the other continues. That break in synchronization tells you something significant is about to happen. Perhaps the music is changing, or they're transitioning to a new routine. SMT divergence works exactly the same way in financial markets. It's a sophisticated technique that identifies moments when two normally correlated markets that typically move together, suddenly stop moving in harmony. Smart money technique gets its name from the institutional players, the major banks, hedge funds, and financial institutions that move billions of pounds and dollars. When these massive players begin positioning for significant moves, they can't simply execute enormous orders all at once without moving prices against themselves. Instead, they operate more subtly, often starting their positioning in one market while temporarily maintaining their presence in correlated markets. This creates temporary breaks in correlation, the very divergences we're learning to identify. SMT stands for either smart money tool or smart money technique. Both terms are used interchangeably in the trading community. What's crucial to understand is that this isn't merely another technical indicator. It's a window into institutional behavior, revealing the footprints that smart money leaves behind when preparing for major market moves.
Okay, so I'll be taking over for this section here. So, real quick, I want to talk about this with you guys myself. Positively correlated is essentially the same thing as saying symmetrically correlated, okay? I know some people that use ICT's mentorship. He talks about it in a way that's more of a symmetrical way, but it's still technically positively correlated. But again, these definitions are used interchangeably. But for now, I'm just going to stick with positively. So when it comes to positively correlated pairs, I have here, for example, Euro USD and GBP USD. When you're talking about a positively correlated pair or assets, these assets move in tandem. They move together in the same direction, whether it's bearish or bullish. They're both moving in the same direction. They're both making higher highs and they're both making lower lows, so on and so forth. Okay? Now, here you see that Euro USD, right, has some breaks of structure here, another break of structure here. But when it comes to GBP USD, you see we have a failed break of structure, or in this case a bearish SMT. This is the asset that broke the pattern, or you can also say this is the asset that is diverging from the original pattern, which was making higher highs, right, making breaks of structures, just like Euro USD is here. We have the break of structure, we had a break of structure here, right? But then it failed to break structure, so this is considered to be the weaker asset, right? It's really that simple. Now, Here I have another example with it's just the same thing, but inverse. So you have breakup structure here, and then again GBP USD broke the pattern, or it's diverging from the original structure, so it failed to break structure here. So this again is considered the weaker asset, and in this case you would have a bullish SMT, right? Because, well, we're going up, right? There's a failed breakup structure. Now when you're talking about negatively correlated assets, so here we're going to use USD, or the dollar, and we're going to use gold. They move in opposite of each other. Now real quick before I go on, I forgot to say, usually these are known as, instead of negatively correlated, some people also call them inversely correlated. All right, so again, just the words are being used interchangeably here, but they mean the same thing. All right, they mean the same thing. So anyways, these assets, when it's negatively correlated, what it's saying is that they move completely opposite of each other. One is going up and one is going down, right? They have to move opposite of each other, otherwise it's not considered negatively correlated. So here I have an example here. Let's say the dollar's making breakup structures towards the upside, and then gold is making breakup structures towards the downside. In this case, gold is the one that broke that pattern, or it's diverging. Instead of making another breakup structure towards the downside, it's made a breakup structure. Well, it didn't make a breakup structure yet, but it failed to break structure towards the downside. So this is the weaker asset. It failed to go down. So we have a bullish SMT, right? Once structure or price fails to continue that pattern, or it starts diverging, that is why it's called the SMT. That is where the SMT divergence comes into play. This part right here, this is the SMT divergence. It's diverging, right? So I know a lot of you guys probably couldn't be confused if I kept going and you didn't understand it very well. I just wanted to quickly clear that up, okay? And then this is just another example with it going towards the downside here with the US dollar, but gold going towards the upside, breakup structure towards the upside, but it failed. So in this case, since gold broke the pattern of breaking structure towards the upside, or essentially not going inverse of what the dollar was doing, then this is the weaker asset, right? This is the one that's diverging. This is causing the bearish SMT divergence, right? So real quick, a break in the pattern is what we call divergence. It's like when something unexpected happens and traders pay close attention because it might mean a change is coming. Whether the assets usually move together or opposite, a break in that normal relationship is what traders call a divergence. Now this next little part is actually pretty important. I'm going to dissect it a little bit. So SMT divergence is more about how the market is behaving at that moment, rather than the long-term health of the companies or assets involved. So while strong fundamentals might support a general upward or downward trend, SMT divergence can still show up due to short-term market pressures or even just big players making moves. All right, so I know a lot of you are going to try predicting SMT divergences based on what is going on with the fundamentals. I know a lot of you are going to look at the news or the earnings reports, whatever. You're going to try to predict that SMT divergence. Don't waste your time, man. You're just breaking your head for no reason. All right, at the end of the day, the market's going to do what it wants to do, and it's mainly the bigger players putting in the orders at that moment in time. So just catch the SMT divergence at the time that it shows up, and that's all you need to worry about.
Now, you might well be thinking, this sounds fascinating, but why should SMT divergence matter to me? There are countless trading strategies and indicators available. Here's precisely why smart money technique stands apart from the crowd, and why seasoned traders often refer to it as the holy grail of market analysis. Firstly, SMT provides early warning signals. Whilst most traders focus on what's already occurred, support and resistance levels, moving averages, candlestick patterns, SMT allows you to anticipate what's about to unfold. It's rather like having advanced weather radar for the financial markets. Secondly, it's fundamentally rooted in institutional behavior. Consider this: approximately 70% of market volume originates from institutional players. When you can identify their footprints through SMT divergence, you're essentially gaining insight into the intentions of the market's most influential participants. Thirdly, SMT transcends market boundaries. Whether you're trading Forex, equities, commodities, or even cryptocurrencies, the principles of SMT divergence remain universally applicable. It's not confined to a single market or time frame. But here's what makes it truly extraordinary. SMT divergence frequently appears before major shifts in market structure occur. While other traders await confirmation that a trend has reversed, SMT practitioners are already positioned for the impending move. Think of it this way: when you're driving and notice brake lights ahead, you don't wait to see the actual collision before slowing down, do you? SMT divergence serves as those brake lights for the markets, providing your early warning system that institutional players are preparing for a directional change.
Before we can spot SMT divergence, we need to understand correlation, because correlation is the foundation that makes SMT work. Market correlation is basically how closely two different markets move together. Think of correlation like a dance partnership. Some markets dance together very closely. When one goes up, the other goes up. When one goes down, the other goes down. We call this positive correlation. For example, the euro and the British pound usually move in the same direction against the US dollar. Why? Because both Europe and the UK are developed economies with similar economic characteristics. So when investors feel good about European currencies in general, both tend to rise together. Now, here's where it gets interesting for SMT divergence. When markets that usually dance together suddenly start moving out of sync, that's when we get our SMT signal. But correlation isn't just about Forex pairs. In the stock market, the S&P 500, Nasdaq, and Dow Jones usually move together because they're all reflecting the same underlying US economy. When tech stocks are doing well, it usually lifts all three indices. The key thing to understand is that correlation is stronger on higher time frames. If you look at a 5-minute chart, you might see lots of random movements that don't correlate. But zoom out to daily or weekly charts and the correlation becomes much clearer. This is why professional SMT traders always start their analysis on higher time frames, daily, 4-hour, even weekly charts. That's where the real institutional footprints show up most clearly.
Now that we understand correlation, let's talk about the key principles that make SMT divergence work. The core principle of SMT is what we call non-confirmation. Here's what that means. When two correlated markets should be making similar moves, but one of them refuses to cooperate, that's your SMT signal. Let me give you a concrete example. Imagine the Euro USD is making a new high for the day, but at the exact same time, the British Pound USD is not making a new high. That's non-confirmation, and it's telling us that something is off in the correlation. Why does this matter? Because when large institutions want to move markets, they can't just buy or sell everything at once. They'd move prices against themselves. Instead, they might start selling in one market while continuing to buy in a related market. This creates the temporary break in correlation that we see as SMT divergence. Here's another key principle. SMT signals are most powerful when they happen at important price levels. If you see an SMT divergence forming at a major resistance level or at a previous high or low, that's when the signal becomes really significant. The third principle is patience. SMT divergence tells you that a move is likely coming, but it doesn't tell you exactly when. you still need to wait for confirmation from price action and market structure before you enter a trade. Think of SMT as a weather forecast. It tells you a storm is coming, but you still need to wait to see which direction the wind is blowing before you decide which way to position yourself.
SMT Divergence comes in several slices or flavors, and understanding each type will give you more opportunities to spot these powerful signals. The first and probably most well-known type is what we call USD index versus Forex pairs. This is where we compare the US dollar index, which measures the dollar against a basket of major currencies, with individual Forex pairs like Euro USD or GBP USD. The second type involves stock market indices. This is where we look at the relationship between the S&P 500 or ES, NASDAQ or NQ, and Dow Jones or YM. These three indices usually move together, but when they don't, it creates powerful SMT signals. Now here's something really important that most traders don't know. Not all SMT divergences are created equal. Some are much stronger and more reliable than others. For example, in the stock indices, if you see the NASDAQ and S&P 500 making new highs, but the Dow Jones refuses to make a new high, that's considered a very strong SMT signal. Why? Because the Dow is often the lagging index. It's usually the last to follow the trend, so when it refuses to confirm, it's a big deal. There are also more advanced types of SMT that we'll cover later, like Tuesday SMT, which focuses on specific days of the week when institutional positioning creates unique opportunities, and shank switching, which involves rapid changes in correlation dynamics. The key is to understand that each type of SMT has its own characteristics and strength levels. As we go through this presentation, I'll show you how to identify which SMT signals are worth paying attention to and which ones you should ignore.
Let's dive into one of the most powerful applications of SMT divergence, using the US dollar index against major Forex pairs. The US dollar index, or DXY, is like a report card for the US dollar. It measures how the dollar is performing against a basket of 6 major currencies: the euro, Japanese yen, British pound, Canadian dollar, Swedish krona, and Swiss franc. Here's how the SMT magic works. Normally, when the dollar index goes up, pairs like Euro/USD and GBP/USD should go down, because you're buying dollars and selling euros or pounds. When DXY goes down, those pairs should go up. But sometimes, and this is where it gets interesting, you'll see the dollar index making a new high while Euro/USD refuses to make a new low. Or you'll see DXY making a new low while Euro/USD refuses to make a new high. That's your SMT divergence signal. Why does this happen? Think about it from an institutional perspective. Maybe a large bank wants to buy euros, but they also need to manage their overall dollar exposure. They might start buying Euro/USD while simultaneously buying other dollar-positive positions to hedge their risk. This creates the temporary break in correlation. The most reliable USD index SMT signals happen on the daily time frame and higher. You want to see clean, obvious divergence, not just a few pips of difference, but clear non-confirmation, where one market is making a significant new high or low while the other refuses to follow. Here's a pro tip. Pay special attention to SMT divergence that happens at round numbers or major psychological levels. If Euro/USD is refusing to break below 1.1000 while DXY is making new highs, that's an extremely powerful SMT signal that often leads to significant reversals.
Now let's talk about one of my favorite applications of SMT divergence, using it with stock market indices. This is where SMT really shines, and it's something that gives you a huge edge over other traders. We focus on three main US indices: ES, which tracks the S&P 500, NQ, which tracks the Nasdaq 100, and YM, which tracks the Dow Jones Industrial Average. These three usually move together because they're all reflecting the same US stock market. But when they don't, that's pure gold. Here's what makes indices SMT so powerful. The relationships between these markets are very well established. The Nasdaq is tech-heavy, so it tends to be more volatile. The S&P 500 is broader and more stable. The Dow Jones is made up of just 30 large companies and often lags behind the other two. Now, here's a key insight that comes straight from ICT himself. When you get an SMT divergence between these indices, the ones involving ES, S&P 500, and NQ, Nasdaq 100, as the diverging markets, tend to be much stronger signals than those involving YM, Dow Jones. Why? Because the Dow is what ICT calls fickle. It often doesn't want to listen to what the other indices are doing. It's like that one friend who always shows up late to the party. So when the Dow is the one creating the divergence, it's not as significant. But when you see the S&P 500 making a new high and the Nasdaq refusing to follow, or vice versa, that's a major institutional signal. These are the SMT divergences that often lead to significant market moves. The beauty of indices SMT is that you can trade it multiple ways, through index futures, ETFs, or even individual stocks that tend to follow the broader market. It gives you flexibility in how you want to express your SMT-based trade ideas.
All right, now we're getting to the practical stuff. How do you actually spot these SMT setups on your charts? First, you need the right setup. I recommend having at least two charts open side by side, your correlated pairs or indices. For Forex, that might be Euro USD and GBP USD, or DXY and Euro USD. For indices, you'd want ES and NQ, or all three, ES, NQ, and YM. Step 1. Start with the higher time frames. I can't stress this enough. Begin your analysis on the daily chart, then move down to 4-hour if needed. The higher time frames show you the institutional footprints most clearly. Step 2. Look for significant highs and lows. You're not looking for every little wiggle in price. You want to see clear, obvious swing highs and swing lows that represent meaningful price levels. Step 3. Compare the moves. When one market makes a new high, immediately check if its correlated partner also made a new high. When one makes a new low, check if the other followed suit. If they don't match, you've got potential SMT divergence. But here's the crucial part, and this is where many traders mess up. SMT divergence by itself is not a trade signal. It's a warning sign that tells you to pay attention. You still need to wait for confirmation from market structure. What kind of confirmation? Look for things like break of market structure in the direction the SMT is suggesting, rejection at key levels, or other confluence factors like order blocks or fair value gaps. Think of SMT as your early warning radar. It tells you where to look and what to watch for, but you still need to see actual price action confirmation before you pull the trigger on a trade.
Okay, so I'm going to show you guys a quick example, but first I want to show you that there is an indicator that you guys can use to find SMT divergences. If you want to make it easy for yourself, I'll link it down in the description below. So you can just leave it at 3, and for this example I will be using S&P as my main trading asset. So whatever asset it is that you're on the chart and the asset that you want to compare it with, you can put it here. Okay, so in this case I want the price that's on S&P 500 to be compared to the price that's on the NAS 100, and as you can see, it's really good at detecting it. So what do we have here? We had a pullback, right? We had a higher low right here, but here we had a lower low. So this asset broke the pattern, so this is considered the weaker asset. Now it's up to you guys if you want to trade the weaker or the stronger asset. Look, I'm gonna be completely honest, I have seen many traders trade very differently. Everyone says trade the weaker asset, or I've heard other people say trade the stronger asset. Guys, it doesn't really matter in my personal opinion. It's up to you guys. And it's whatever works best for your trading plan. Just make sure you're back testing it, okay? Please just make sure you back test. That's what matters at the end of the day. And another thing, make sure you are trading with the trend. And I know I'm gonna sound like I'm yapping, but this is very important. Guys, if you trade with the trend, that is really all you need. SMT divergences, liquidity pools, or this other like extra fancy stuff that ICT tries to teach. I'm not saying it's useless, but what I am saying, it's a bit overkill, because at the end of the day, you have people like Doyle Exchange making crazy money. He's very successful with this trading, and he keeps it extremely simple. If you guys look up how he trades and what his exact trading plan is, you'll see that this guy uses supply and demand order blocks. That's basically all he uses, and maybe a moving average to find what direction the trend is going. But that is literally it. He keeps it so freaking simple. You don't hear him talking about SMT divergences. You don't hear him talking about breaker blocks. You don't hear him talking about any of that kind of stuff. Like, this guy keeps it incredibly simple. So remember, guys, as long as you are trading in the direction of the trend, you should be fine no matter what strategy you use. Okay, so with that being said, let's get back to the example here. So real quick, you see that price had an SMT divergence here. Right here it is. This is why, because price failed to make a lower or a higher high, but here we had the higher high in this area. So remember, it's always best to trade with some kind of point of interest. So once you see that, you can also see that it reacted into what? It acted from this order block, right? So you see an SMT divergence here, you have an order block. You're trading in the direction of the trend, right? And you're trading on the 15-minute time frame, right? Not bad. And it's like what, 1:45. So you still have some pretty good time to enter into a trade, obviously depending on your trading plan. So what can you do? You just enter after the rejection of that, stop loss into this order block, and you could have gone for like a 1 to 2, right? Keep it very simple. And that's it. That's all you need, man. It's that simple. Like, I'm not even going to go any further than this. This is really all you need. All right. It's just, you can even stick on just a 15-minute time frame, and that's all you'll need, guys. You don't even need to add multiple time frames if you choose not to. Obviously, you can. For some of you guys, you might have a better win rate. Some of you guys might actually have a worse win rate. Just depends on how you are as a trader. But point being is that you don't need to overcomplicate it, even when you are trading with SMT divergences. Remember, the SMT divergence is simply a warning that it gives you of what's going on in the market. Nothing else. It's not an actual buying signal or a selling signal. It is just another confluence. But again, guys, I personally think that you don't even need it.
Let's break down the two main types of SMT divergence patterns you'll encounter, bullish and bearish, and I'll show you exactly what to look for with each one.
Bullish SMT divergence happens when you're potentially looking at a market that's about to reverse higher. Here's the pattern. One of your correlated assets makes a lower low, but its partner refuses to make a lower low. For example, let's say Euro USD drops to a new low for the session, but when you look at GBP USD, it didn't make a new low. It held above its previous low. That's bullish SMT divergence, suggesting that the selling pressure might be exhausted and we could see a reversal higher. Bearish SMT divergence is the opposite. This happens when one asset makes a higher high, but its correlated partner refuses to make a higher high. So, continuing with our Euro USD and GBP USD example, Euro USD makes a new high for the session, but GBP USD stays below its previous high. This suggests that the buying momentum might be running out and we could see a reversal lower. Now, here's the critical part, and I see traders make this mistake all the time. You never trade SMT divergence immediately when you spot it. SMT tells you that a reversal is possible, but you need to wait for confirmation. What does confirmation look like? For bullish SMT, you want to see a break above a recent high, or at minimum, failure to make a new low. For bearish SMT, you want to see a break below a recent low or failure to make a new high. The strongest SMT divergences happen at significant price levels, major support and resistance, round numbers, or previous daily or weekly highs and lows. When you see SMT divergence forming at these key levels, that's when you know you're potentially looking at a high probability setup.
Now we're getting into some really advanced stuff that most traders never learn about. These are concepts that can give you a serious edge in your SMT analysis. First up is Tuesday SMT. This is a specific timing-based approach to SMT divergence. The idea is that institutional players often establish their weekly positioning on Mondays, and by Tuesday, you start to see the divergences that reveal their true intentions for the week. Tuesday SMT setups tend to have a higher success rate because they're based on institutional weekly planning cycles. Next is the concept of lagging assets. In any correlation relationship, there's usually one market that tends to be slower to react than the others. In stock indices, for example, the Dow Jones (YM) is often the lagging asset compared to the S&P 500 (ES) and Nasdaq (NQ). Understanding which asset typically lags is crucial because when the lagging asset is the one creating the divergence, it's often a weaker signal. But when the typically leading asset diverges, that's when you pay serious attention. The third advanced concept is shank switching. This is when you see rapid shifts in correlation dynamics, almost like the markets are changing dance partners mid-song. This often happens during major news events or market stress periods, and it can create some of the most powerful SMT setups. Here's a pro tip that comes from years of studying SMT. The most reliable divergences often happen when the stronger market in a correlation pair is the one that refuses to confirm. For instance, if the Nasdaq is typically leading the S&P 500 higher, but then the Nasdaq refuses to make a new high while the S&P does, that's a very strong bearish SMT signal. These advanced concepts take time to master, but once you understand them, they'll significantly improve your ability to identify high-probability SMT setups.
This is where SMT divergence really proves its worth, helping you identify potential market reversal points before they become obvious to everyone else. The key insight here is that SMT divergence often appears before major changes in market structure. While most traders are looking at what already happened,
breakouts, breakdowns, moving average crosses, SMT traders are seeing the footprints of institutional positioning that suggests what's about to happen. Think about it from an institutional perspective. When a large bank or hedge fund wants to reverse a major position, they can't just hit the market with a massive order all at once. They'd move prices against themselves. Instead, they start positioning gradually, often in related markets first. This creates the divergence patterns we see in SMT analysis. One market starts showing the institutional bias while its correlated partner continues in the previous direction. It's like seeing the foundation being laid before the building goes up. The most powerful reversal signals come when you see SMT divergence at what we call institutional reference points. Major daily highs and lows, weekly extremes, monthly levels, or significant round numbers. These are the levels where institutions are most likely to be managing risk and establishing new positions. Here's something really important. SMT divergence for reversals works best when you combine it with other confluence factors. Look for things like previous structure levels, order blocks, or fair value gaps at the same price area where you're seeing the SMT signal. The beauty of using SMT for reversal identification is that it gives you early entry opportunities with excellent risk-to-reward ratios. While other traders are waiting for confirmation that a reversal has happened, you're already positioned based on the institutional footprints you spotted through SMT analysis. Remember, markets don't just randomly reverse. There's always a reason, and that reason is usually institutional repositioning. SMT divergence helps you see that repositioning as it's happening.
Let's talk about how to use SMT divergence properly and avoid the mistakes that trip up most traders when they first start using this technique. Best practice number 1, always start with higher time frames. I can't stress this enough. SMT signals on 5-minute charts are mostly noise. The institutional footprints that create meaningful SMT divergence show up most clearly on daily, 4-hour, and 1-hour charts. Best practice number 2, use SMT as confluence, not as a standalone signal. SMT divergence tells you to pay attention, but you should never enter a trade based solely on SMT. Wait for confirmation from price action, market structure, or other technical factors. Best practice number 3, focus on strength and weakness relationships. Pay attention to which market in your correlation pair is typically stronger or weaker. When the typically stronger market is the one creating the divergence, it's usually a more significant signal. Now let's talk about common pitfalls. Pitfall number 1, taking every SMT signal. Not all divergences are created equal. You want to focus on divergences that happen at significant price levels, major highs and lows, round numbers, previous structure points. Pitfall number 2, ignoring the strength of correlation. Before you can trade SMT divergence, you need to verify that your chosen markets actually have a strong correlation. Use higher time frames to confirm this relationship. Pitfall number 3, being impatient. SMT divergence can signal that a move is coming, but it doesn't tell you exactly when. Some SMT setups take hours or even days to play out. Don't force trades that aren't ready yet. Pitfall number 4, wrong time frame analysis. Many traders spot SMT divergence on one time frame, but then try to trade it on a much lower time frame. This creates a mismatch that often leads to poor entries and exits. The most important thing to remember is that SMT divergence is a tool for understanding institutional behavior. When you approach it with that mindset, looking for clues about what the big players are doing, you'll make much better trading decisions.
Congratulations! You've just completed a comprehensive journey through one of the most powerful trading concepts in the ICT methodology. Let me quickly summarize what we've covered and give you a practical checklist you can use immediately. Key takeaways.
SMT divergence works because it reveals the footprints of institutional activity through breaks in market correlation. When markets that usually move together suddenly don't, it's often because large players are positioning for a significant move. Remember the main types: USD index versus Forex pairs, stock indices like ES, NQ, YM relationships, and advanced concepts like Tuesday SMT and lagging asset analysis. Each has its own characteristics and reliability levels. The pattern recognition is straightforward. Bullish SMT shows when one asset makes a lower low while its partner doesn't. Bearish SMT shows when one asset makes a higher high while its partner doesn't. But always wait for confirmation before trading. Here's your practical checklist. Identify strong correlations on higher time frames. Start analysis on daily 4H charts, then work down. Look for SMT at significant price levels. Wait for market structure confirmation. Use proper risk management and position sizing. For further study, I highly recommend diving deeper into the ICT 2022 mentorship materials, joining active trading communities focused on ICT concepts, and setting up dedicated chart layouts for SMT analysis. Remember this quote from ICT: SMT divergence is the Kraken correlation. When it shows up, the big guys are about to make a move. SMT divergence isn't just a trading technique, it's a window into understanding how institutional money moves markets. Master this concept, and you'll have a significant edge in your trading that most retail traders never develop. Thank you for joining me on this journey through SMT divergence. Now, go practice these concepts, start with small positions, and gradually build your confidence as you see these patterns play out in real market conditions. Happy trading!
Alright, so thank you guys so much for watching the video. I hope you guys learned something from it. I know I didn't add enough trading examples, but if you guys are interested in that, you guys can look at Sir Pickle's channel, TT Trades, and there's like a whole bunch of other videos that show this kind of stuff. So shout out to all those guys, and shout out to Mulham Trading and ICT, because, well, they were a very important resource for making this video. Now, if you guys have any more questions on this, you can join the Discord, ask me questions there, DM me on IG, on Twitter, email me, all that good stuff. So before I go, you guys know I love leaving you guys with some wisdom. And this is from the Wisdom of Solomon 6:12. Wisdom is radiant and unfading, and she is easily discerned by those who love her, and found by those who seek her. Ladies and gents, that's all I have for you today. I hope that, again, that you guys learned something, and if you want, reach out to me. I'll do my best to answer you. And as always, strive for progress, not perfection. I'll see you all in the next one. Peace.